Good evening. Ira Epstein of Linn and Associates with your evening wrap-up of your SPDR ETFs for this Wednesday, June 10th, 2020. All right, my friends, interesting day. Before we go to anything here, let's take a look at what the Fed did. And at any point, you can pause this to read. What I typically do in my written updates for my futures traders is I will put out the highlights and I write a newsletter that's meant to be short, easy to read, get you to the points. I'll highlight ideas that I'm having leading into potential ideas, could be for trends or the economy, what's going on. Simply put, the Fed is throwing everything it's got at the market, and it's not going to let up until we get out of this mess. Can I make it any simpler for you? I hope not. They think the decline, if you look at the bottom here, in the second quarter GDP, which just ended, will be the largest on record. So they're looking for a really bad number when they tell you that. The Fed is also going to look at yield curve controls. They are going to think it takes time to get 20 million displaced workers back to work, and they're concerned that what's happening could happen again. They have to be humble, they said, about their ability to lift inflation. It's simply they couldn't get it up to their goal, and they're still not there. It's parlance also for them to let the market overshoot if inflation starts picking up. So those are the things you start looking at. We had a mixed day, but the metal markets came alive after the Fed talk. Now, the futures markets get their settlement price at 12:30 p.m. Central Time, but they trade to 4 p.m. So when you look at the futures settlement, you go, it was down. Well, it was. It's also sharply higher tonight to take into account all that. Why they do this and they don't do what the stock market does, I've never agreed with. It used to be the hedgers and the London fix nonsense. This is modern day. Move on. Get to where the end of the day is the end of the day. I keep telling them that, but I have no say. That's all I can tell you. I had marked for you yesterday the highest breakout numbers that we had, well, not breakout, but the highs we had at 102.94 and XLK. We're over it today. And there was a rotation today. The tech stocks stayed strong and weakness started showing up and showed up in the SPY, in the QQQ, and the IWM. As we take a look, and we'll get to those in a moment, you can see that you're still very much in this uptrend pattern of higher lows, higher highs. I realize to some of you that's so basic. Folks, it's beyond it. Start watching financial TV, and many of you have because you've been home for months. You hear this talk all the time. Start watching and learning about moving averages. That's what traders looked at. Today I'm watching at the end of the day as Josh on CNBC was talking about the 200-day moving average, brought up a chart and showing the resistance. I bring this up to you all the time. So I just do it in my own vernacular. It's the same type of things, but I have my own twists and turns as he does. As you look at the tech sector here, you're still running to the upside. The Bollinger Band has been acting as a resistance, and only 5% of the time will you stay over a Bollinger Band. Now, you rarely see Bollinger Bands discussed on, be it Fox, be it CNBC or Bloomberg. I think they're super important. Major important. Maybe super is not a strong enough word. You'll stay over that band, you can 5% of the time, but the algorithm will adjust itself to the market. This is a powerful market. It keeps running against that upper number. The market doesn't get back under the 18-day average of closes, and it keeps the pattern of higher lows, higher highs. In addition, the slow stochastic oscillator, you've heard of MACD and RSI, it's just another one of these. It converted itself at the end of April into embedding into May, and it's just kept going on, and with it, the prices have run. I mean, I still think on pullbacks, the trade will be buying this market until the red line closes under 80, and at that point, I'll look for price in the 18-day average, wherever it's at, to try to make a run at each other. It's not, I don't see it on the horizon yet. In SMH, we still have the embedded reading. You have the pattern of higher lows, higher highs. You've pulled back into the Bollinger Band, which makes all the sense. Why? Because 95% of the time you'll trade within the band. That doesn't mean you've lost anything. If the market decides to rally up, that should be the resistance. On pullbacks until this number's lost, that red line under 80, I say the trade will be aggressive to buy the market. Now, tomorrow's going to be very important. Why? Overnight, we're going to see just how first Asia, the traders there wake up, what do they do in the market? Then Europe, because they're all going to get a chance then to review the FOMC statement, the actions, and so on. We're done. So you'll get an edge. Do you step into these markets, or if you see the future sharply lower for any reason, maybe you pull back like that. That's the edge you get by this market opening at 8:30, and you get to see what the futures are doing. If you tie together my morning subscriber video with your end of the day SPDR ETF, you get a package. We're putting that package together as a subscription right now to give a price off if you take the two. Okay, so if I come over here to the XLI industrial sector, now I'm nervous. 80.17, the number is not under 80, but when you close it near the lows of the day, unless the market jumps sharply the next day, the way that the formula works on slow stochastics, most of the time it's going to lose the embedded reading. This is the one I'd stay away from or clear the decks of, because you might be headed back to the combination of 68.80 to 68.11. Again, look in the morning to see what's going on in the futures. In the SPDR ETF, you lost the of the XLE, you lost the embedded reading. Out, out, out. That's all I can say. When you see that happen, the odds favor that unless the market gets some big reversal, and you don't play for that, it's the one thing to come out. I think traders are actually, if this market doesn't gain it back, they're going to think the short side to get back to these two numbers tomorrow. Would not surprise me at all. This, to me, rules the day. Do we understand that? When you lose it, it often leads to price and the closest moving average coming together. That is right now the 100-day. Problem is, I know how this works, you're probably going to see the 18 jump over that number in the morning. It just makes the sense. In the QQQ, just powerful, but ahead of itself. Over the upper Bollinger Band, no, no, no. Markets only stay above it 5% of the time. So wait for it to come back. This is the strongest part. I say the trade will buy this market. It'll be their favorite index to buy on the pullbacks, and you lose the embedded reading, then I think you're going to the 18-day average. So that's still the one I think they're in favor of. In the emerging market ETF, I don't like when markets get over the 200-day average and don't come down and challenge it again. I think this market's set up to do that. So I'd be waiting. This is not my favorite play, even with the embedded reading. I'm certainly not in the bear camp, but if you go back and you look on these first challenge of long-term moving averages, it's hard to get away from it. It's like gravity pull. It keeps pulling it back. Let's see what happens. In gold, gold turned bullish. B-U-L-L-I-S-H. Got it? Higher lows, higher highs until today's low, because it's an outside day up, is taken out. I'd look for the pros to be looking if they can get back to that 18-day average. That would be a number they want to support. If the market continues up, I think they'll be looking at the upper Bollinger Band. Once again, that lower band proved to be a very important number, especially the first test of it. Gold miners, not with gold yet. It could be tomorrow on a close over the 18-day average. What did it do? It certainly negated the downtrend, because if you look at this day's high, it was 33.47, and this day's high was 33.58. Got it? So the market today slid through all that. Again, an outside day up until today's lows taken out. The market, I think, will try the upside, but notice that first challenge of the 18-day average pretty much stopped the market. TLT, you lost the embedded reading. Now let's go back here. You lost it here on Monday. You know what I say. The closest moving average is your first target. That would be the 100-day average, which it jumped, and there you are. This is Tuesday. Today, the market takes off. So I wouldn't be surprised if it tries to complete this up move into the 18-day average and then figure out what it wants to do next. You still have an oversold condition that corrects itself either with sideways or higher action. So we'll see what goes on there. FXE with the embedded reading, still bullish. Maybe the futures got a little ahead of themselves today, getting over the 114 level, so be a little bit careful there. You know, one of the things that I love to do is teach ideas, and I don't know if you know in the stock parlance how to use pivot points. Pivot points, it's a formula that helps you find support resistance points for in and out trading. That's what I use it for. Now, sometimes I'll bend it and I'll say, gee, I want to be long this market, or I want to be short this market. Where can I enter to find it? So what it does is a formula, and we teach it. It's a 3-part video series, and I do the first parts with with PowerPoints. Then I use actual charts. You're looking for the pivot point. That's your neutral number. Above it, you have resistance 1 and 2 and supports 1 and 2. What you're trying to do is get into the market on a short side to get back to the pivot, or buy it at the support to get back up to the pivot. But again, I'm going to repeat it. It's day trading. It's in and out. You get some of these markets that move pretty good in these ETFs and spiders, and they have enough action to make this make sense. I then tie it together. This is how a chart would look. I tie it together for you with slow stochastics to give you what I think is possibly a momentum edge as the market gets up or down to a point. As I said, it's a 3-part video series, and it's free. Just go to our website, www.iraepstein.com. Under free offerings, you'll see it all right there. You can also click up here. It'll take you right there as well. I'm Ira. You have a good day. I'll see you all tomorrow.